I believe I said that every deal was a bit scary. $400 million market order. I didn't dollar cost average. I just sold everything and bought everything all at once. In early 2016, this guy was living on his Model 3 because he was homeless. In 2021, he retired at age 39 with a Tesla portfolio worth $12 million. How did he do it? Today, we'll break down Tesla investor Jason DeBoltz's winning Tesla strategy, the strategy that made him $12 million in less than 8 years, and show you how Tesla bulls can use his methods to retire early too. How often and when could we buy if we're set on using the DeBolt method? How many shares will it take for us to retire and start sipping my Tays in Honolulu? Tune in to find out, but first hit the like button and subscribe. He sold his house to buy another 10,000 shares in early 2023. Bolt now owns 48,000 Tesla shares, but he started out with just 7,500 shares that cost him $2 in April 2013. 50 a share at the time, a 19000 initial investment. DeVolt studied business economics and grew familiar with concepts such as game theory, compounding opportunity cost, and supply-demand, key ideas to his investment strategy, as these tend to support long-term and exponential positions. While the Bolt's concepts sound complex, his strategy was quite simple. His technique can be summed up in two basic principles: one, buy at every opportunity, and two, never ever sell. The second of these principles, never ever sell, has made the Bolt famous even today, as young retiree DeBolt makes headlines as the Tesla multimillionaire who refuses to cash his lottery ticket, having never sold Tesla shares for a profit. This principle would be tested early on for. The Bolt is 3 months after his initial April 2013 investment. Tesla stock more than doubled in price from $30 to $80 a share. This figure is pre-5-to-1 and 3-to-1 split, as his friends and family advised him to sell. Each new Tesla stock acquisition got progressively scarier, but he held on, buying an additional $12,000 in May 2013, 150 pre-split shares and $82, and then another $20,000 in November 2013, 142 shares at $141 pre-split, and $26,000 in March 2014, equaling 111 shares at $235 a share. What would it look like if you employed the Bolt's 2013 to 2014 never ever sell strategy in Tesla today? What could the results be over, say, the next 4 years between April 2013 and March 2014? The Bolt purchased $7,700 worth of Tesla stock. This signified a substantial portion of DeBolt's base salary, which at the time approximated $105,000 after taxes. One could say that the Bolt devoted nearly 100% of his annual net earnings on Tesla stock that year. The median net salary in the United States is around $46,000 a year. What would happen if you, making $46,000 a year, decided to go all in this year and invest all of your net proceeds into Tesla stock, much like the Bolt did between 2013 and 2014? At this time, Tesla stock price is $188. As of now, investing $46,000 in Tesla stock would get you about 245 shares. What will the price of these shares be in 4 or 5 years? Different predictions exist, but let's start with ARK's bold prediction that Tesla could sell for as much as $20 in 2027, 7 million cars by 2027. With an average selling price of $26,000, Tesla will make $528 billion from EV sales alone. The $26,000 average price assumes that Tesla has mastered pricing and is operating at very efficient margins, since the basic Model 3 is currently priced at $42,990. However, ARK's model says that Tesla will make more money from East rather than EVs, predicting that the company will make $613 billion in annual revenue from autonomous ride-hail. With this huge net profit, Tesla's gross margin would reach an amazing 52%, and the overall EBITDA margin would reach 34%. Based on ARK's Vest and EV projections, Tesla's market cap should be over $7 trillion by 2027, $9 trillion, and its share price should be $2,500 per share. How does this compare to the return of 2013 to 2014 to Bolt? The Bolt, they invested $77,000 in about 12,000 post-split shares that are now worth more than $212 million, which is a 28 times return. But keep in mind that this return is calculated over 10 years, not the 4 years that ARK predicts will happen in 2027. A real 4-year comparison only gives us 3 times for DeBolt, because the price of Tesla stock only went up by 30% from 2014 to 2018. Your upside, should ARK's bold projections be realized, would be much higher. Your 245 shares purchased in mid-2023 for $46,000 would be worth $612,500 by 2027, an astonishing 13 times return in 5 years, or less when projected over 10 years. ARK's bold projection would be on pace to even outdo the Bolt's 28 times.
Incredible return. If you think that's too optimistic, listen to what DeVolt himself had to say when he sold his house in early 2023 to buy more Tesla stock. Tesla is the next Tesla. This company is just getting started. We might not see a company like Tesla in the next 50 years. DeBolt believes there are huge gains still to be made, and that it is relatively early in the Tesla stock investment game. The opportunity to buy into Tesla with a never-sell mentality may still be available to us investors in 2023. Let's move to the other integral component of the Bolt's winning strategy. Don't wait, buy at every opportunity. Keep watching for projection of how your portfolio would look like once you employ all of the Bolt strategies today and seize early retirement. The end result is crazy, and you don't want to miss it. The principle of creating buying opportunities. might be the riskiest and most controversial portion of the Maltz playbook, and it involves something called margin. Margin is the practice of borrowing money from a broker to purchase securities, such as stocks, bonds, or mutual funds. The investor typically pays a portion of the investment amount known as the margin, while the remaining portion is borrowed. Margin allows an investor to purchase more stock, but
comes at the risk of merging calls. When you borrow on margin, the broker who lent you the money requires that you maintain a certain ratio between the account's equity and the total value of the assets held in the account, at least 25 or 30%. The risk is that market fluctuation can diminish the total value of the assets, which could bring your ratio below minimum required levels. In these cases, brokers will demand additional funds to maintain the ratio in a process famously called margin call. Failure to meet a margin call may result in the broker liquidating your stock to cover the losses. The Bolt employed margin beginning in 2014. Remember that Doubles' most recent cash purchase of Tesla stock was for $26,000 in March 2014. Incredibly, that same day was also Bolt's first purchase of Tesla stock on margin, and incredible $82,000 worth of stock on one go. That was an extremely aggressive move for Diebold, as his stock portfolio, then consisting of about 1200 Polk split stock, was only worth about $180,000. His 82000 margin purchase left the portfolio with a margin maintenance level dangerously close to margin call territory, but he was just getting started on margin. After taking a long break on September of 2015, Diebold transferred his Vanguard 401,000 into a self-directed 401,000. After liquidating his Vanguard 401,000, DeWalt was left with around 250,000, which he immediately threw at Tesla stock. Purchasing 1000 shares on one go. DeWalt's strategy in liquidating his 401,000 proved a genius, calculated move. 1 month later, on October 2015, DeWalt purchased another $120,000 worth of Tesla stock, about 600 shares at $200 a share, entirely on margin. The Bolt bootstrapped to the 1,000 shares from September 2015 as collateral, allowing him to request additional funds from the broker to purchase another 600 shares a month later. At this point, the Bolt was certain that Tesla was just about to have a major break, thinking that these would be his final opportunities to buy the stock this cheap. Diebold did the unthinkable. He declined to renovate his lease and become homeless, living on this Tesla Model 3 so that he could put any rent money he saved straight into Tesla stock. Diebold lived out of his Model 3 for about 6 months, using his employer's headquarters for food, bathrooms, and other needs. Diebold says that this experience helped him accept his risk-everything mentality with Tesla stock. He had proven to himself that everything he needed was in that little Tesla, and that if things got tough, he could go back to living a simple life. Diebold's homeless run is a lesson in courage and managing expectations that all investors can learn from. Diebold put all $15,000 he saved on rent straight into his next purchases, 2 huge purchases totaling $10,000 in April 2016. He then doubled and tripled his investments, buying an amazing $330,000 in 2017 and $300,000 in 2018, all on margin. But on October 9th and 10th, 2018, the cracks in his plan started to show when his brokerage Fidelity raised their margin maintenance requirements without warning. This meant that Bolt had to sell $70,000 worth of Tesla stock all at once to meet Fidelity's margin call. This call was just the beginning of 5 more between the fourth quarter of 2018 and the first quarter of 2019. The Bolt had accumulated enough shares, despite the problems, to become a multimillionaire by the time Tesla stock started its crazy rise in late 2020. These margin calls would be his or her last margin plays. Dean Bolt admitted that he wasn't fully prepared to invest wisely on margin, and that his margin mistakes cost him around 4,000 shares, which is about $4 million at Tesla's peak valuation. However, investors can still learn from Bolt's buy at every opportunity mentality. Let's look at how the average investor could use Bolt's margin strategies. Remember that if the average person invested their $46,000 net salary today into Tesla stock, those 245 shares could be worth $612,500 by 2027. Well, assume that that person also has an average 401,000 account and is 40 years old. The average 401,000 account balance at the age 40 is around $90,000. Now imagine that you pulled a Bolt and liquidate your 401,000 in order to buy Tesla stock in a self-directed 401,000, those $90,000 would earn you another 489 shares, double the 245 you purchased with your annual salary, and would leave you with a grand total of 734 shares worth $135,000. But this is where margin comes in. What would happen if you were to go all in an employee margin on your $90,000 401,000 funds instead of buying the shares cash? Typically, margin agreements allow you to borrow up to 50% of the purchase price of new marginal investments, allowing you to buy double the amount of stocks. Compared to using cash, only borrowing 50% would be the riskiest scenario and would open you up to potential margin calls, because this ratio is close to most brokers. Maintenance margins, which typically require that your equity not fall below 30 or 40%. If the value of Tesla stock falls in, you purchased at 50 margin, then your equity could fall below those numbers. Another catch is that your broker could change the maintenance margin on you at any time. And in a scary moment, as in the recession, it is possible that they arbitrarily set even the 60% equity requirement. With that said, 50% makes for simple examples. So we'll assume You are a massive risk taker and use the full buying power available to you. This is where things get interesting. If you were to employ the $90,000 from your $401,000 at 50 margin, you would be able to purchase $180,000, 50% on your cash in, 50% on the cash lent from your brokerage for a total Tesla stock investment of $226,000, which would get you around 1,205. 21 shares today. You could also then leverage the 245 shares you purchased cash. With your annual earnings of $46,000 to get more stock, you can borrow against them at 50%, allowing you to buy another $23,000 worth of stock, bringing your total Tesla investment to $249,000, which would get you about $1,345 with $90,000 borrowed from the brokerage in connection with the $401,000 funds and $23,000 borrowed in connection with your initial purchase of 245 shares you would owe your brokerage. $113,000 whilst holding a stock portfolio worth $249,000. This signifies a 45% maintenance margin, a dangerous maintenance margin by any measure. Whatever dangers may exist by taking on such high margins, the gains on Tesla stock could also be exponentially higher. Suppose you use your $90,000 $401,000 funds to buy 489 shares cash. Then suppose ARK Invest bolt projections were realized. Your foreign fiscal would be worth $1,222,500 in 2027, a gain of $1,132,500 after subtracting the original $90,000 investment. But what if you used 50% margin instead? As we've already talked about, this would allow you to buy 978 shares instead of 489, which could be worth $2,445,000 in 2027 if ARK's bull production comes true. This is a gain of $2,350,000, which is more than double the original game. But we can't forget to subtract any interest paid on the margin loan. Taking out margin is the same thing as taking out a loan that must be paid back in full. Assuming an interest rate of 8% and making the minimum monthly interest payment, the total interest costs would add up to $29,200 over the 4 years between 2023 and 2027 by taking out the interest costs on the $2,350,000 gain. Our total net gain for our $401,000 margin portfolio is $2,325,870. This is still a huge gain. That is more than double what we would have gotten with cash. When you add the $2,355,401,000 gain to the $612,500 from the initial salary-based share purchase of 245 shares, the average investor could walk away with $2,938,000. If they used the bolts method and saved a year's worth of salary, they could walk away with $2,192,390,000. We want to stress again that this is the best case scenario based on a number of good assumptions. For example, we assume that there will be no margin calls due to changes in the market during the 4 years from 2023 to 23. Still, a $3 million retirement with an initial $136,000 investment is a huge upside and one that rarely comes about without the extreme determination, commitment that characterized a bolt from 2013 onwards. Now onto the real juicy question: when a Tesla stock portfolio worth $3 million in 2027 allow our hypothetical testy hero to retire large in a first world paradise such as Honolulu, Hawaii, with DeBolt's techniques suffice to fund all those overpriced Mai Tai San margaritas? The answer appears to be it depends on what you do with your $3 million. DeBolt, a true Tesla believer, has chosen not to liquidate any Tesla shares and is instead living off a margin loan. In early 2021, the Bolt tweeted, "Soon I'll be able to merge and borrow about $3 million at less than 1%, but I will probably only borrow up to 8% of the value of my liquid assets. This way, I never have to sell my shares at the time." 8% of his assets equaled about $1 million. So DeWolt's idea is to live for years off that million without the need of selling any shares and paying extremely low interest that is probably offset by the gains in his portfolio if you're a default purist and seek to employ his never sell technique. Even here, things could be harder with a $3 million portfolio. You could, of course, borrow close to $1 million employing the maximum margin loan allowance, but at this leverage, you would confront the serious risk of a margin